Welcome back to the Dividend Diplomats YouTube channel, everyone. Lanny, Bert, come on, everybody. You know us by now. Today, we're going to talk about two stocks that got absolutely hammered this week after they released earnings. And we're going to run them through the screeners and just talk about what our take on the earnings are and what the heck we are doing with them after.
Before we get hammered, subscribe to this channel, give the video a thumbs up. Two dividend growth stocks here, one even a Dividend King. Took the rocky left, got uppercutted from the rocky right. Do they have another round with Ivan Drago coming up here or not, Bert?
I don't know, man. It looks like it. So let's just take a step back quickly and just talk through oh, yeah. There you go. I haven't used mine in a while. So everybody, wait, pull that back up. Pull that back up. We haven't talked about this in a while. It's our Dividend Diplomats coffee mug. If you're looking for one, check out the store below in there. It's a great cup of coffee. The ones in our store have the color on the inside too, so it's a nice little touch and feature. But just check out that store below.
All right, guys. So the market was wild. Fed increased interest rates another 75 basis points at the range of 2.25 to 2.50. Markets reacted very favorably to this. Another consecutive negative GDP quarter was announced. Obviously, the fear of a recession could be here, possibly. And obviously, these are two huge companies, Bert.
Yeah.
I know you own both of them. I own one of them.
Yep, and that's the thing. We're also in the heart of earnings season as we're going through it. So some companies are popping. You had Google pop. You had some of the other major companies jump after their earnings release. Other companies, you're starting to really see the impact of inflation, supply chain issues trickle through those Q2 results. So you have some great surprises, some bad surprises. And for the bad surprises, the market is punishing them for that. And that's exactly what happened with these two massive stocks that we are going to talk about today.
Straight punishment, guys. We're going to dig into them again. I think, Bert, one of them you said after earnings went down over 10+%. Dropped probably about $20 in share price. The other one probably would dropped around that 7 to 10% mark on Friday, July 29th. Both have low PE ratios. Both have, growth streaks of growing that dividend. Can't wait to see what this is all about here.
Yeah. So let's jump right in, Laney. What do you think about that?
I got my swimsuit on. I'm on the diving board, man. I'm looking around. Let's go. Let's jump in, man.
Company number one. Man, this is everybody's least favorite stock right now. Market, social media punished the you-know-what out of this company. Intel. I don't know. There's nothing more to really say to tease it. This first company we're going to talk about today is Intel. INTC.
Intel, man. Food, man.
These results were not great, Landy. I think for the quarter, revenue was down over 20%. But the more alarming thing was the compression of the company's gross margin. I think that was the piece that I think caught people by surprise, where it dropped from gross margins typically in the 50%, 50s range, and it was in the 30% range for the previous quarter. So costs were climbing. Things weren't great for Intel.
Now, the CEO, though, in that earnings release, they say that we're probably at the bottom of where they're seeing. So hopefully they're at the trough right now. So the question is there now more upside for Intel stock, for the Intel shareholders? I know they did lower a lot of guidance and forecast and forward-looking statements for Intel, but what were those adjustments?
Yeah, so now from the numbers that were 3 months ago, previously, EPS was at $3.60 a share. Now, guidance has dropped all the way down to $2.30 per share. Revenue, guidance, $76 billion. They've dropped down to the $60 to $65 billion range there. So not small. Those are pretty substantial drops in guidance for the company.
Yep, and that sent the stock obviously tumbling. Not only did they have poor performance this quarter, but then lowering guidance, another hit to the stock price. On top of that, Bert, I don't know if you've mentioned it yet, but they actually had a net loss for the quarter.
We haven't gotten to the net loss yet. That's a fantastic call out there for Intel.
Oh man, it's very weird seeing that, but I'm not really I'm not digging into the details in their income statement and line items. I'd love to see their GL for the impacts there, but one would think that this is as worse as we're going to see it for Intel.
Yeah. Intel's going to start releasing their detailed general ledger accounts to everybody so they can run their own analyses.
This
No,
is
but
why.
yeah, there are some. I mean, I'm not going to sit here and say things are great, but let's just talk about the major thing too. Congress passed the CHIPS Act, so that's kind of been the thing that's been holding up a lot of the investment that Intel, AMD, and the other companies have been looking to make in there. So that's finally moving, so they can now proceed with a lot of their plans to bring production back to the U.S. to avoid future supply chain issues. They have the massive Ohio plant coming. They have the massive Arizona plant. Those things are going to take time, though. They're not going to be instant gratification here for Intel. So we're going to work through some of these short-term earnings for maybe long-term gains, but who really knows? I think that's the other thing, too. I don't want to be too rosy about it and say it could be great 5 years, because these numbers were a little troubling.
Yeah, yeah, I couldn't agree more, guys. Again, so Intel, their stock price took a hit. They're now trading at $36.31 as of the market close July 29th. We're going to dive into the Diplomat stock screener, focus on the three metrics: price to earnings ratio, payout ratio, dividend growth, and we're going to throw in the cherry of the dividend yield, especially with Intel, because they're at now a yield threshold that we haven't seen in a while. But Bert, first metric, what's that price to earnings ratio look like?
Price 36.31, forward EPS 257, PE ratio 14.13. So discount compared to the market, which is in the high teens. So keep that in mind. Showing some signs of undervaluation. So moving to that second metric though, and see how do they perform in the rest of these. The dividend payout ratio. And I think looking at dividend payout ratio for these two companies is going to be as important as ever, especially with declining results, declining performance, because we are long-term dividend investors. We want to invest with companies that can pay and grow a dividend in the long term. Payout ratio increasing significantly above our 60%, closer to 100%, is a very early indicator that a company may have to cut its dividend in the future. So for these two stocks, payout ratio is going to be key. Lanny, what is Intel's payout ratio?
So yeah, the payout ratio, they pay again 36.5 cents per share per quarter, or $1.46 per share per year. Payout ratio is at a solid 57%. In that perfect payout ratio, you can still sleep at night, per se, that the dividend is going to at least remain there. But again, as we go into dividend growth, we may not see that strong of dividend growth. So, Burr, what does dividend growth look like?
5-year average dividend growth rate is about 6-ish%, and their years increasing they've done it for 7+ years. So to your point, with results like these in future investments in chip plants, I would not expect strong growth from Intel in the future.
Yeah, I would expect at least the next year to 2 years for there to be lower dividend growth for Intel, but they may pay you to wait, because guys, that cherry metric, that dividend yield, you guys love the yield, which is how much they're paying you right now to own it. As we know, the SoFi's, Allies, the Marcus accounts are all yielding between 1.4 to 1.8%. But Intel will give you a dividend yield right now at this price at 4.02%. I haven't seen them really cross 4% in a long time.
Yeah, and year to date, their performance down 31%, down 50. They're down 32% in their last 52 weeks. So yeah, that's exactly why their yield is just now popping to above that 4% threshold.
It's amazing. Guys, Intel at these low level thresholds. In summary, the price to earnings ratio is at 14, payout ratio 57%, dividend growth 7-year streak at about 6+%. Yield is over 4%, but probably lower dividend growth going forward. Decent stock, Bert, but man, they are getting pummeled by everybody and anybody. This is like the no holds barred match where you get tossed out of the ring and all the lumberjacks are just whooping on you outside.
Yeah, and every time you get in the ring, the lumberjacks just keep pulling you right back out. That's where Intel's stuck in right now. Exactly. Them and IBM just can't catch a break.
Yeah.
You're
not done.
No. Speaking of other companies that are just getting pummeled outside the ring, Stanley Black & Decker, ticker symbol SWK. So they released earnings this week too, and I was very interested in them because we started buying with my wife around when they were around 130 per share. They got crushed with earnings last time. They dropped into the low hundreds, low teens, so we kept adding to it. We now own 22 shares at an average cost basis of 117.95. That's where they were about. We were about even going into earnings release this week. Now, after earnings, the stock price is at 97.33. So, like you teased earlier, Lanny, this company dropped $20 per share after this earnings release. Down, yeah. So now we're at a 17% hold in our position at Stanley Black & Decker.
So, one of the key pieces here is Stanley is now down 48%, guys. Guys, if you've owned Stanley this year, you bought them on literally December 31st or January 1st, you're down over 45+%. I know it's tough right now. I know it's hard. I know your stomach probably has pains. You're probably grabbing that toilet seat like you just ate some colon blow. But guys, this is a Dividend King. Let's just keep that in the forefront. Dividend King has been around, been doing this for a while, 50+ years of dividend increases, which we'll get into that. So guys, let's keep that in mind. I know there's bad blood going on right now for Stanley. Sorry, Bert. I know I'm trying to give you some optimism. Right?
No, there is some optimism because you got to not so much. I mean, there's some. The same thing though. You can't be too rosy. They rode the home buyer build. They rode the DIY boom that happened over the last few years. What's happening in the broader market? Spending slowing down. All the extras, DIY projects are probably the first thing on the list that are getting chopped and put onto the back burner. So of course, Stanley Black & Decker is going to feel some pain too in the short term. I just don't think people were expecting as much pain as the company showed. I mean, when you peel back the earnings release, net income dropped to 57 cents per share. Compared to the same time last year, it was 275 shares. So just to show how much net income fell. Their gross margin fell to 27.9%. It fell 800 basis points as they're caused by inflation and supply chain issues. And I think the one thing that really caught everybody's attention is their inventory jumped up. So that tells you right there that demand for their products are cooling because you're seeing higher inventory, which means dead assets sitting there until they sell. So they're either going to have to sell for lower prices, cut down the prices, take some of the inventory at loss, or they're just going to hold on to it, and that's free cash flow that they can't deploy elsewhere.
Right. No, I mean, can't really say otherwise right now here for you, B. I mean, I think, again, similar to Intel, it's that margin pressure, that margin compression. But again, it's because they were dealing with probably currently increasing costs. They probably couldn't increase price fast enough. So again, I feel like this is a very similar story as Intel. I think the second half of this year is going to look a lot better than the first half.
Yeah, and I mean, they're tampering down expectations too. They slashed guidance like crazy. So adjusted EPS guidance was at $9.50, was at $10.50. Now it's down to $5 to $6 range. Pretty substantial. And yeah, anytime you drop guidance $4.25 per share on EPS, that's going to catch people's attention. So you're right, Lanny. I hope you're right. I love the optimism though, because it takes some relief in the supply chain, relief in some prices to start bringing some of those DIY projects back that could help catapult Stanley Black & Decker into the future.
Exactly. All right, well, let's dive into the metrics. That first metric, price to earnings, with the $6 earnings per share expectations on the $97.33 price of Stanley Black & Decker, your price to earnings ratio is 16.22, a little bit higher than Intel, but again, a very low PE ratio for this Dividend King. Bert, payout.
Their new annual dividend after this dividend increase, which we'll get to here in a moment, was $3.20. Divide that by the $6 EPS using the range. That is your perfect payout ratio of 53.33%. Again, everything we said about Intel, you can apply to Stanley Black & Decker here. They're still in a pretty safe payout ratio range.
Pretty safe payout ratio. And again, we've talked about it many times on this channel and on this video. The Dividend King, over 50+ years of increase in their dividend. Obviously, the dividend growth rate is pretty sad right now because that last increase was about 1.3%. So dividend growth has not been great, and may be low on a go-forward basis right now for Stanley.
I would say so. And you keep talking about it. They're a Dividend King. They've increased the dividend for 54+ years. So this isn't their first slowdown that they've been through. This isn't the first time. This is why you like companies that are Dividend Kings, because not every year is going to be great. There are going to be some down years, but they've demonstrated they can increase that dividend through the good times and bad.
They can do it. So guys, again, dividend yield now is over 3%, 3.29% on the dividend yield front. I mean, I remember I'd get kind of excited when they were at enter the 2% range.
Yeah, well, now they're in the 3% range. So get more excited. So let's summarize here. Stanley Black & Decker, 16 PE ratio, 53% payout ratio, 5-year dividend growth rate. Not the best. Dividend King with a yield of 3.29%. Okay, so what are we doing here? Before we get to Intel, I'll just tell you what I'm thinking with Stanley Black & Decker, since I own them separately. They're not the screaming undervaluation that they were when we were buying them last week and the few weeks before, especially with that EPS cut. So right now we're holding. We're not going to be buying anymore. I grabbed 2 shares under $100 because I had to grab it under 100. Just personally had to be there. We own 22 shares now. We'll see where this rides out. I don't expect them to pop anytime soon, so I don't need to run to get a deal. Lanny, what are you thinking about Intel?
Intel. I mean, I'm not sure yet what to really make of it. It's kind of that similar when Verizon drop below like 45, it's like, yeah, grab a couple shares. If you want to grab 3 shares of Intel for $100, go ahead. It's not going to kill you, but at least you're grabbing it at low prices. Somebody has already probably done that then. So
yep.
Go ahead, Bert.
Had to at least grab 3.
So yeah, I mean, that's kind of, where I'm at with it. I own a pretty big position of Intel. But again, I feel like there's a lot of demand for chips, and I feel like Intel is still a big player in delivering on that.
Yep. Both these stocks, it's going to take a long-term mindset, though, if you're doing it. So if you're looking for short-term gains, probably wouldn't think about these companies. These are going to take a long-term mindset if you want to see the fruits potentially of them. That's where you got to be. So let us know what you think of Intel and Stanley Black & Decker in the comment section below. Let us know what other dividend stocks you're seeing that you own that haven't had the best earnings too, that may be undervalued in time to buy.
Yeah, let us know if who's been picking up these 2 stocks over the last 2 days, the 2 business days, finishing off July 29th. What other stocks are you buying? Are you finding value as the market finished off a really strong July, quote unquote? Let us know in the comments. If you haven't already, definitely subscribe to the channel and give this video a thumbs up.
Everybody, let's just keep buying those undervalued dividend growth stocks.
That was Bert and Lanny from the DD, over and out.